Time for Chart Attack, where we bring you a chart that will make you smarter. Hopefully, it'll also make you some money. Well, over the past couple of months, stocks have been moving up. The data, on the other hand, it's been moving down, and it looks like they are finally coming back together. Dean Curnutt, this is one of the things you look at. Data goes one way, stocks go another. Talk us through this whole concept.
Yeah, so what we're trying to do is find instances in which the economic data doesn't match up with the price of things like stocks. And so more recently, especially when Japan went all in on their monetary experiment, what we started to see was this huge risk-on rally, carry rally, where folks were buying stocks, buying bonds, just everything, essentially trying to earn some yield in an environment where all the central banks are doing QE. And so what we started to notice was stocks were levitating. Remember, they were up to 1680
Sure.
at the highs. And yet the economic data, the profits data was sort of okay. Not terrible, but okay. And the economic data, not all that great. And so we use this function, great function on Bloomberg, ECSU, economic surprise.
Now we're getting to the chart. I say, well, let's bring in the camera and show everybody what we're looking at. And we're superimposing the Bloomberg Economic Surprise Index with the S&P 500 index. And generally, in the past, stocks have followed the data.
Yeah, not surprisingly, right? So one of the factors for stocks is just the broad economic climate.
Yep.
And so when the economic data tends to disappoint, stocks will react. You get a bad payrolls number, for example, stock prices might go down. The correlation's not perfect, but certainly you can just eyeball and you see the general degree of correlation.
Right here, all of a sudden we had the Bloomberg Surprise Index turned down. We had stocks still going up, but now stocks have started to come down. In other words, maybe they're coming back together again.
Yeah, exactly. And so as the stocks were levitating, the S&P up to the all-time highs, and the data, the economic data, was disappointing, we had to ask ourselves, is this just all QE?
Right.
Is this the chase of investors just trying to earn performance in a market that's done so well and has rewarded risk-taking, even though the data has been, generally not that great? And will they ultimately come together? And with the Fed starting to talk about maybe taking a bit back via this tapering language, now suddenly maybe the stock market has to look at the overall climate. Profits are decent, not great in terms of growth, and then the economic data, as we show in the surprise index, has been generally underperforming.